In this video, we are going to talk about when not to enter a trade, when not to get in the markets. This is going to actually save you money and actually to improve the profits that you are actually going to make in trading if you follow through what we are going to be saying. By the way, if you have any other thoughts, comments on what we are going to discuss in this video, you can leave them in the comment section below. I enjoy reading your thoughts and your comments. So if you are also new on this channel, please consider subscribing so that you do not miss future videos. Like the video. If you don't learn one or two things in this video, I am hoping that at least I've entertained you for a few minutes. So the least that you can do for me is to just like the video. If you are looking to download stuff, forex robots, indicators, books, and the sort, there are links in the description box below. Visit those links. Everything that you get from there is for free. On this channel, everything that we give out is for free. Many people also ask me about the broker that I use. See the link in the description box below. So going back to the subject of our video, when not to enter a trade. When not to enter a trade. Again, this is not an exhaustive video. It's not everything that every reason in the world, but this should give you a start. So when not to enter a trade. First of all, for me, is when you are trading lower time frames and you are about to enter a trade just based on a 15-minute chart. You are not even aware of what the 1 hour chart is saying or what the 4 hour chart is saying. Forget about the daily. The daily is usually in good combination for those trading the 4 hourly. But usually you find people are eager to get into a trade, say on the 5-minute chart, a 15-minute chart, a 30-minute chart, and they have absolute no clue what's happening on the hourly or what's happening on the 4 hourly. So what you find is sometimes it might look like the market is bullish on the 5-minute chart. But when you look at the 4 hourly chart, it's massively bearish. So people actually end up getting caught on the wrong side of the market. So do not enter any trade unless you have checked the higher time frames. You need multiple confirmations. It might be also indicators that you are using. If you are still relying on indicators, you cannot just rely on one indicator. You probably want to look for a price action pattern, then you combine it with maybe a moving average cross, or maybe a Fibonacci level, or a MACD, stochastic, whatever that you are using. But you cannot just enter based on one thing. What you need is confirmation. Confirmation on your price chart, confirmation on the indicators that you are actually relying on. Secondly, you cannot enter the markets or place any trades when you are not even aware of any news that might be coming up that day, because you might actually have a spectacular entry. You might have a spectacular strategy, but then FOMC happens. Interest rate announcements from Bank of Japan, Reserve Bank of Australia, Bank of England happens, and your perfect trade can easily go against you if the market reacts opposite what you were trading. So the first thing before you enter in trades, especially on the lower time frames, is to understand any news that are coming up for that day, especially the high impact news. Know when they are going to be coming on. We live in different time zones. Know exactly when the high impact news is going to come, depending on where you are on the planet. Then take steps. If you're already in the trade, then you obviously want to put in a good stop loss. Or if you're not in a trade and you're not sure, you're not confident, then definitely stay out of the market, at least until after you see the impact of the news. Then, when not to enter a trade, I used to do this same thing myself. Don't enter trades before a candle close. Before a candle close. Candles are funny things. They are funny things on the charts. Sometimes you can see a nice candle that looks like it's going to be a massive bullish candle before the time frame, whatever time frame that you are trading that candle, before it closes, it actually drops and produces this massive wick, and in sometimes it actually turns out to be a bearish candle with a massive wick. It happens, and you easily in that situation get caught out on the wrong side of the market. So what I actually learned is, if you are trading 5 minute chart, it means you are trading 5 minute candles, and you see what you believe is a good trade setup or a good signal. You have to wait for that 5 minute candle to close before you enter the market, or you must wait for that 15 minute candle to close before you actually take the trade, or you can enter on the at the close of that 30 minute candle, that 1 hour candle. If you are trading on 4 hour candles, you must let that 4 hour candle close. Sometimes it might look like it's going bearish, and trust me, it will reverse on you the moment you place your sell trade. So let that candle close before you decide whether it's still a good trade or it's not. Of course, there's always temptation that you might be missing out on a lot of money, and other people are making money, and you're out of the market. It happens, which brings us to our next point. Don't enter any trades if you are feeling the effects of FOMO, fear of missing out. If you suspect that you are afraid of missing out, it looks like the market is taking off, and you are not in it. You cannot place a trade in that state. That's how people get caught on the wrong side of the market, and it's especially important if you are trading supply and demand support and resistance like I do, and you are placing your trades on key zones. If price has already moved from that zone, I don't chase it. I used to, and it usually got my hands bent. So I don't try to chase trades anymore. Don't chase the market. If the market is taken off and you were not part of that move, then be patient. The market is always going to present you with a lot more opportunities, but are you going to be there for those opportunities? That's what you need to decide on. So don't chase trades. If it's gone, it's gone. Even if it looks like people are making a whole lot of cash, let them make a whole lot of cash. Your opportunity is going to come. The market always comes up with new opportunities every day. Then Don't enter trades when you are too excited. When you're too excited, unusually excited to enter that trade. Usually, sometimes it signals either greed or that you are under the influence of FOMO, or you really haven't checked out the market correctly. So don't be too excited to enter the trade. What I'm saying is calm down. Calm down. You spot a setup, don't excitedly rush in and place your buy or place your sell. Calm down. Do your checks according to your strategy, according to the way you trade the market, according to your trading plan. Is it a good entry? Is it a good entry? Don't excitedly just buy and sell. And usually when people are just overcome by excitement, they forget about their trading plan, they forget about their trading strategy, and they usually what end up in trouble. So hopefully these tips can help you avoid bad trades. uh, we said look for multiple confirmations on time frames or on the indicators that you're using, the signals that you are going to be using. uh, Look out for news, major news. Try to avoid trading when news is going to hit. We said be patient enough to wait for your candle to close. That candle, that signal candle that you are looking at, just let it close. Just let it close and see if it's still a good trade. Don't be influenced don't be influenced by fear of missing out. It's hard to do but for some people, but don't chase trades. Don't chase trades. Don't be too excited to get into the market. Sit back, relax, and make sure you have done all your checks. Check everything. I hope you learned one or two things in this video. Subscribe if you are not yet subscribed. Like this video. Until next time, bye.